Hey, Eric here from 5minuteinvesting.com, and welcome back to my YouTube channel for investing. So in this video, we're going to talk about really the power of compound interest, why it makes such a difference, and what is the number one mistake when it comes to compound interest. And then afterwards, we're going to dive into a couple of scenario analysis where we're going to look at the return for different return over time, like the dollar return for different percentage return over time. We're going to talk a little bit about my return and also how Warren Buffett, can grow his portfolio over such a prolonged period of time. Okay, so if you're not familiar with compound interest, it is actually quite simple. It's all about you put $100 in today, and then you make some money, you leave it in the account, and then you reinvest and reinvest and reinvest year after year and really allow your reinvestments to grow and grow and grow until the end of time. So you can think of it like a snowball. You can think of it like a power curve. You can think of it like, a startup initially is unknown and suddenly one day the price just shot up. So that is all the power of compound interest. And that is really what got Warren Buffett so rich is, selecting great companies and then allowing them to grow year after year. All right, so what is the number one mistake when it comes to compound interest? And that is really looking at compound interest in the short run. So here I have a return calculator, and this is a calculator I use when I'm chatting with my clients and basically helping them understand what kind of return they can get from the market. So right now I have a default 7 and 30%, but for this scenario, let's use 3%. Okay, that is pretty low in my opinion. I think if you are on this channel, you're probably somewhere between 4 to 7%. If you are on the high end, you're going to be closer to 10%. Now, imagine you just invest $10,000. And I'm just going to make it simple. You have $10,000 to invest. It might be $100,000 for you. But essentially, here it is. You invest $10,000 today. Now, by the end of year one, you're going to realize that you made $300 gain. From a 3%. This might be a mutual fund that has a mix between equity and bonds. That's pretty minimal. It's not really moving the needle. And if you divide this by 12, that is like 20 something dollars, $30 a month. So it's not exactly very helpful. Okay, but if you look a little bit further, just 5 years from now, you're going to make 338. So it's actually a bit more, but it's still not moving the needle. Now, if you go down and like 20 years later, the final year, you're actually making 526. Now, using a 10,000 and 3%, this is probably too low that you can see that allow you to see the difference. But let's say you want to make 7%. Now, why 7%? 7% is really because the stock market on average goes up by 7% year over year. So then if you use 7%, that is pretty much what you're going to get from an ETF fund. If you are choosing an all equity ETF fund, minus 1% management fee, so that's 6%. So 7% is pretty accurate for people who are investing in the stock market, assuming you have a balanced portfolio. So the first year, you only make $700, which is actually not a lot. And then in year 5, you actually make $900. So then you can see if you look at what you're making in year 5, the gain is actually a lot higher than year 1. And that is really the power of compound interest. And as you go on, if you look at year 20, each year you're making around $2,500 each year. So as you can see, the gain you get each year by reinvesting your profit really compounds and grow over time. So that is really the power of compound interest. Now, if you only have an account of 10,000, that is probably not very exciting initially. And this actually means that you should save some money. So, as you're saving money, your account is going to grow by saving and also grow by compound interest. So here, let's say, you have saved quite a bit of money and you grew it to $100,000. Now, when you look at the numbers again, it becomes much more attractive from initially $7,000 here to, $9,000 in 5 years and $12,000 gain in 10 years. So you can see that this is almost double of the initial year. So when you're looking at compound interest, it is really important to look at the gain you get over a long period of time. Now, a 3% or even just a 2%, this is really the kind of gain you're going to get, from a money market fund. And if you look at 7%, that's really the gain you can get from a stock market, more or less. And you can actually see the growth trajectory for your portfolio. After 20 years, if you invest in a money market fund, you're only getting $148,000. Now it is positive, that is great. I know a lot of people out there that are making a loss on investing. So this is still positive, but when you factor in inflation, inflation is 2 to 3% a year, sometimes higher, you're not really making a real gain. So this is probably not, growing fast enough when you're comparing with inflation. The cost of food is rising, the cost of medical is rising. So when you are going to retire, you need to think about that. You need to think about inflation. So if you are investing in something like money market fund, this is essentially a 0% return in terms of real return. Now, let's say you invest in the stock market and you make 7% return. And you'll see that it grows much faster, and the difference, really becomes the greatest at the end of 20 years. And that is really the power of compound interest and the power of making a higher return. So if you look at this, you see, it's double and a little bit more. So you can see by investing in the stock market, even though it's more volatile, if you can get 7%, is way better than investing in money market fund. Now, this is really, what economists call nominal return. So that means before adjusting inflation. But if you adjust for inflation, this is really 0%. And if you adjust for inflation, this is really 4%. So as you can see, after 20 years, you only get to double your money. So if you save $1 today and you invest in the stock market using an ETF fund, after 20 years, you double your money. So it's not a lot. It's not quite enough to move the needle. And that's why people, when they're talking about retirement, they always want to save, until they have $1 million. And that's why the retirement age keeps increasing. Now, okay, let's go back to nominal return. So what if instead of stock, you're going to use something like stock options? So it has an element of leverage in it. Now, here is a quick warning for you. If you don't understand stock options and if you're not familiar with it and you're still in the learning phase, that is okay. Just make sure you don't use it when you invest in the market, because you need to be very, very clear that you can make money from the stock market using options. Now, what's interesting here is if you use options, I would suggest you to target somewhere around 30%. 20 to 30% is pretty good. So just try to target 30%. That's my goal on an annual basis, and I think that is quite a reasonable goal. And if you don't have a financial background, maybe you're a doctor, a lawyer, an engineer, or even an accountant, I think aiming for 30% when you're using options is quite doable. But if you're not using any form of leverage, then I think aiming for something like 10% is much more reasonable, assuming you know how to pick stocks, enter at a good time, so on and so forth. So if you are able to use leverage, then the first year, you're actually going to make $30,000 using a $100,000 account. And you can see right off the bat, this is making a much higher return in terms of dollar value than $7,000. Okay, so this already allows you to get much closer to your financial goal, whether your financial goal is to have $60K a year or $90K a year. Now afterwards, imagine you grow this portfolio by 5 years. Now you can see that the 5th year gain is $85,000 and your portfolio it's only $371,000. So it's quite an interesting growth compared to 7%. And for a lot of people, the median income or the happiness income is really around 70K. So there was a study done in the United States, I believe, that if you have around 70K in terms of income, then you'll be a happy person, and any additional income will not help you. But of course, it will help in terms of building a safety nest. So what you'll notice is what people really want is not to build $1 million portfolio. What people really want is actually to have a gain that is enough to sustain their lifestyle year after year. So I know I can already feel it the moment I present this number, this 85,000. A lot of people are going to say that, well, you're not going to be able to get 30% every single year, Eric. So for the last 4 years, I'm able to get more than 30% every single year. But of course, you can treat me as an outlier. So instead, what are you going to do? You're actually going to aim for a higher balance before you retire at 300K. So let's say you aim for 600K and then you retire. So then that is still a lot less than $1 million. And then that will provide you with a higher gain, which you can have some extra leftover. So that is really the power of using option. And as you can see, if you let a portfolio grow for 30% year after year, you're going to get to 19 million by the end of 20 years. So this is really an ambitious goal. And I think if you look at Warren Buffett, I think he made 20% on average year over year. So I don't think you're going to get 30% every single year, but I think it is a good target to aim at. Because if you can aim and get 30% for multiple years, you're going to get to this figure, 370,000 really quickly, and hence you're going to be making around 85K for that year, which is probably more than enough to replace your income, or at least replace majority of your income. So that is really the difference between stock versus option, and we previously covered the difference between money market versus stock. Okay, so now I just want to share a little bit about my return. I started investing over 12 years ago, and at first I was losing a lot of money because I was day trading, I was short-term trading, and it just wasn't working out for me because my investing strategy is not cohesive, it's not congruent, it's not working together. Now, after I cracked the code, I target 30% year over year. So, for the last 4 years, my annual average return is actually much higher. It's actually 55%. And for the last 4 years, I have made over 450% from the market. So as of the day I'm recording this video for you right now, my portfolio is actually in 6 figures already. And when I first started, I started with a very, very small account of only $3,000. And I worked really hard to save money. And I also, of course, invest and made quite a good gain so then I could grow my portfolio to where I am today, which is just around 300,000, so right around here. So if I'm making 30% this year, then I'm already at the point where I'm making 65K this year. So I'm already in the 4th year of my journey. And right now, I'm helping a lot of other people without financial background, just like yourself, with a full-time job, learning how to invest using stock options so they can be, here or even somewhere here as well. So I've seen a lot of case studies where people without a financial background, whether they're a doctor, a lawyer, accountants, actually accountants have financial background, or engineers, can master investing in less than 4 weeks. And, this is not, you can achieve 30% without day trading. You can achieve 30% without short-term trading. It's really about knowing how to use stock options to multiply your profits the right way, and then letting the market work for you. So if you are wondering how much time is actually needed to invest in the market, my answer for you will be around 1 hour a week. Now, You might be saying, well, Eric, you figured this stuff out a long time ago. You invested for over 12 years, so of course it only takes you an hour. So I will reply you and say, fine, just give yourself 2 hours then. That's okay, right? 2 hours a week is not that much of a time commitment. And that's talking about once you know what the strategy is. So once you have a cohesive, congruent strategy, it is really about picking great companies, buying at a discount, using stock options to multiply your profit, and then you wait. And it's actually quite surprising to a lot of people because the gain is quite important. The gain is actually quite significant compared to investing in the ETF fund. Now, here's an example. Let's say I'm looking at the first year. Now, the first year, if I make 30%, I get 30K. How long does it take if I invest in an ETF fund to get 30K? And the answer is 4 years. So within 1 year where I'm able to generate 30%, that's already more than enough to cover 4 years of ETF funds. So that's quite an important observation because, think about how much time you can save. Think about how fast you can retire if you are able to just find a couple of stocks that allow you to generate 30%. And I think a lot of misconception really comes from that if you want to make a higher return, you need to take a lot of action, you need to trade a lot, you need to make a lot of trades. And that is really not true because if you look at my portfolio, right now I have around 8 stocks in total, 8 stocks for a 6-figure portfolio. And on average, I invest around 4 or 5 times a year. That's it. I find the best time to enter. I find the best stocks, in my opinion, to enter. I find, when it is on a discount, and then I use stock options to multiply my profit. And by doing so, only 4 or 5 times a year, I'm able to grow my portfolio to this level. So a lot of my students have success as well. And that is really the power of compound interest. The power of compound interest is not in the first year. The power of compound interest is in the last year when you take your money out. So, whatever you're doing, whether you're saving for retirement, saving for your kids' education 18 years down the line, the power of compound interest really comes into play on the very, very last year because the gain, you can see here, is like almost triple of the first year gain. So the 85,000 you see here is triple of the 30,000 you see in the very first year. So I think that is quite an important observation, and I hope you're going to take this concept of compound interest and instill it. So then when you are making a profit from the stock market, you don't want to take the money out and just keep your full-time job for a little bit longer. So then you allow your portfolio to compound and grow in your favor. So if you're interested in learning more about investing, I do offer a free webinar called How to Make 30% from the Market down below. So you can click on that and you can watch it. And I kind of explain how I invest in the market using long-term investing using stock options. And I do offer a coaching program called Investing Accelerator. So that is a full step-by-step, click-by-click coaching program where I teach you how I can invest using 1 hour a week in the market. So the program is approximately 4 weeks. Most people can finish within 4 weeks. Some people finish in 2 weeks or less. So that all depends whether you have a lot of time or not a lot of time. So that's pretty much it. There are a couple more links down below for resources to help you grow as an investor. If you like, you can click on those links and check them out. So if you like this video, you can click like, subscribe, leave a comment below, and let me know if you have any questions. I'll see you in the next video.